Our next guest expects the S&P 500 to have a shallower pullback than most expect. We're going to talk about this, and he has some ideas on how to play the current sector rotation. Right now is right now is Robert Sluymer. He is the technical strategist at Fundstrat Global Advisors. So explain this.
So the market's up very sharply between the October lows and November, and most technicians, you look at almost every trading indicator, it's overbought. So there's a lot of concern that the market's going to pull back. That's sort of the generic call out there. But I think the messages and what we have to be very careful about is getting too focused on the very short-term data. Because the bigger picture is still very, very bullish. When we look at the long-term market cycle data, and we've talked about this before on the show, where the S&P put a low in at 2346, right off that 200-week moving average, that 4-year moving average. So the cycle looks very normal to us. Looks very similar to what we saw in 2016, 2011. In fact, it looks very similar to the cycle pullbacks that we saw in the 50s and 60s and 80s and 90s. So well, there's a lot of concern about trade and politics and short-term technicals. We don't want to get lost in the trees for the forest. And I think the bigger market cycle argues we're going much higher from here.
So, but tell me about just how you think professional investors think about December. Does that factor into your thinking at all? Because,
boy.
No. To me, that's a huge component of how the investor class operates, right? Hedge funds, at some point, need to try to lock in whatever they can. When are they going to do the lock-in? How that factors into this? I don't know.
Well, we have the same sort of situation in September. There's a lot of mutual fund year-ends in September and October, so that's another part of it. And in terms of year-end, I think the sort of the generic call is that we get a year-end rally. Right. But so it's obviously going to depend the direction.
Well, that's the conflict here. There's sort of the conventional wisdom is that there's a pullback, but then there's another view that there's a rally. So you tell me where we are.
I can only look at the data the way I see it.
Right.
And the way I see it is you've got to be very, very careful anticipating and wanting to rotate back to defensive names right here, just given the bigger market cycle. I think it's such an important view. When you start trending in a market, overbought stays overbought. And so if we're looking for this near-term pullback and trying to micromanage a trade, getting out and trying to get back in going into December, I think it's pretty high risk.
I do think the December tactical psychology matters, but it can change on a dime. So first of all, people were very, very defensive and very fearful in August and September and got positioned that way. So what we've seen so far, I think, is just relief, people regaining equity exposure, kind of trying to make sure they don't get left behind. But if we were to pull back 2%, let's say, over the next couple of days, weeks, whatever it is, I think the conversation would turn from, wow, we got to chase this rally into December to make our year, to, well, we got to lock in what we have. Right. Because if I'm a hedge fund, I get paid an absolute return. So we're already up 23% in the S&P or 24% year to date.
I just think that trying to micromanage a 2% trade is really, really hard. You got to get out, you got to get back in again. And I get the trading side of it. We do it all the time. But the bigger picture continues to be the market's moving higher here. And
how much higher?
I think meaningfully higher. I don't know about the year-end number. I think that's not a relevant focus right here.
Out, or how
let me give you a couple of examples. If we look at the average 4-year market cycle, right, the market tends to rally sort of 2 to 3 years up and then pulls back. Kind of a normal business cycle. Whether that's in play or not is sort of debatable. But if you go back to the 50s and 60s and 80s and 90s and you look at that average sort of rally and the average pullback's around 22%. We just had that last year. The average rally is 100%. Secular bull markets, I'm not talking about the 70s or the 30s, but the average rally is 100%. That's a big number. The minimum is around 62 to 64%. That's exactly what happened in 2016, and that takes us up to about 3,800 by 2021.
Okay. And that's when you finally get bullish.
What, 2021?
No, when you hit that 3,800. This market looks pretty good.
Just the average cycle, this number's going to sound crazy, but it's 4,800, 4,500.
Robert, thank you. Appreciate it.